Today, we are going to talk about not only long-term care insurance, but some of the other more innovative new products that are on the market. I'm Drew. I'm here at LTC Tree with my cousin and business partner, Derek. Hey, Derek.
Hey Drew, what's going on today?
Hey, we're just here to kind of cover a relatively new topic, something that we've been doing the last few years that a lot of people may not know about.
Yes, so a bit of history about us. You kind of touched on it briefly. Is we're LTC Tree. So for years, decades since 1999, our 26th year, we did long-term care insurance. So we basically helped consumers shop the long-term care insurance market with all the companies all over the country. And what we found over the years is people who are retired or approaching retirement, they got a couple concerns. Really, one's the more personal concern is what if I need long-term care? Because they've seen their parents need long-term care in an assisted living facility for years, or they had an aunt, uncle, or they had a friend who fell off the ladder cleaning the gutters and was paralyzed. So, what happens if you need long-term care? That was a big concern. But another concern with this same type of client is a lot of those people were searching for long-term care insurance because their parents lived a long time, so they have good genes on their side. They're concerned about, hey, what if I outlive my income? So that's kind of what we're going to talk about today.
Yeah, and we've been doing this long enough to where I know you and I both, on a regular basis, we have conversations with past clients. And, I remember one client I was just talking to recently. He was actually a professor at Princeton back when he bought this policy. And now he's well into retirement, but he's still just as sharp as he was, 20 years ago or, 18, 20 years ago. And so these conversations have kind of stoked us to start thinking about how we can, continue to provide value for our former clients who do, like you say, they got good longevity. And one of the tools that we've found over the last few years, in particular, mainly due to macroeconomic reasons, are the fixed index annuities. So let's go there to start.
Yeah, so the annuity market, we're not talking about variable annuities. That has to do with securities. We don't offer those. We're talking about the fixed index annuities, and that's heavily tied with the Fed funds rate. And so, you know, early 2000s when I first got in there, annuities were decent. But then the housing crisis, the financial crisis, the mortgage crisis, 2006, 7, 8, that's when the interest rates started to plummet. And the Fed has kept interest rates, that Fed funds rate near zero for 15, 20 years, up until 2 years ago when we started having inflation. So, up until then, annuities weren't really a viable option for retirement planning. But now this is as good as they've been as far as the interest rates paid to the consumer as they've been since the mid 90s.
Yeah, so I think a lot of people that are watching this may still think of annuities as kind of a bad word. And we felt the same way for a long time because of that sort of macroeconomic, the interest rate thing that you talk about. We're both economists by education, at Georgia and Clemson, arch enemies, but we somehow still get along. Um, but I think a lot of people, they hear the word annuity and they, for a good historical reason, have an immediate impulse to like pull back and say, no, no, I don't want that.
Yeah. Annuities for years, they were high commissions and then low interest rates. Now, you're still paying commissions, but that's kind of baked into the cake. And we work on commissions just to be fair, but the interest rates they're paying right now are 5x better than what they were to the consumers. So the value proposition is much better than it was just 3 years ago. I think it was January 2022. That's when, the Ukraine war started, gas prices were surging and food prices surging. That's when the Fed really started ramping up that interest rate. Bad for consumers, but it's good for, the people who are looking at the fixed rate market. And so there's products out there right now that will guarantee you an 8% compounded return on an income basis for the next 10 years.
Yeah,
And
I mean,
that
we
was
haven't seen anything
5% a
like
few years
that
ago.
in our entire career leading up to this moment. So we do really feel like it's kind of a unique time for people to take another look to get that lifetime income component to kind of fill in a gap that the long-term care plan fills in a big important gap. Then there's the income component because of, like we said, those good genetics that so many of our clients have. And so that's kind of the background. Now let's get into the, sort of the meat and potatoes of what actually is available to someone who's kind of curious about this.
So I was working on a case for a client earlier who is 65 years old, and they have a portfolio of probably $3, $4 million. And we're not talking about putting the bulk of your assets into annuity, but if you put in 10, 20%, I think they're looking at putting it in $500,000 of a $3 million portfolio. And they really were, using funds that they had invested in bonds and CDs and stuff like that, leaving the bulk of their assets in the market, let it continue to grow because we love the stock market. But for this portion, that $500,000 in 5 years, that was going to guarantee her, I think it was a $65,000 return. I'm sorry, annual payment for the rest of her life. And it's cash money. You can spend it on anything. This is not just like long-term care insurance. It's just income stream. But they would double it for 5 years if she needed long-term care. So she didn't have long-term care. I'd been talking with her for years. She's been thinking about self-insuring the risk, but just not ready to jump on the insurance bandwagon. But this kind of perked her interest because it gives her a lifetime income stream, but at the same time, it gives a little bonus if she ends up needing long-term care, paid in cash.
Yeah, and I think a lot of people will immediately, again, that knee-jerk reaction say, well, what if someone buys one of these plans and obviously it works out really well if they live, 10, 20 years into the future. But what if someone buys this and then they, predecease that 10-year, they die in a few years? Is the money just gone?
Yeah, that's I think going back to your earlier point, why annuities had a bad connotation. It used to be that way, 20, 25 years ago. You'd annuitize, and so you lost control of your lump sum. That's not the case anymore. So, you have two competing buckets of money. You have an income column, and that's where you're guaranteed to get that 8% compounded return for 10 years. And that's competing with the actual performance of the index. And that's various indexes, the S&P, the Nasdaq, Fidelity, Morgan Stanley, these various indexes that you can put your money in, that's actually what determines your lump sum value. So you never lose control of your lump sum. So if your actual index value grew to say from $500,000 to 800,000, say you turned on the income payment in that fifth year and it paid you 2 years of an income and paid you 100 grand, and then you died, they're simply going to debit $800,000, whatever the contract is valued at, less what they paid you. So your heirs would get the remaining balance. Now, if
All
you
right.
lived 30 years, there could be a point in the future where they've paid you more payments than your actual annuity's worth, and then so you kind of beat the house in that one.
Yeah, and so speaking of beating the house always wins. What is the incentive? Because I know a lot of people are thinking this in the back of their head. Not many salespeople are going to really talk about this, but
Right.
what is the incentive of the insurance company to offer these great products? How do they win on average versus a policyholder?
That's a great question. So an insurance company, they have an advantage is that they're like an entity. I mean, they're going to be around. They've been around for 100 years. They're going to be around for another 100 years. So they have time on their side. So they don't need to win on every single contract. You need to win on your contract, obviously. But the insurance company, if they have 1 million people, customers out there, they only need to win on a percentage of that million. So if you beat the odds and you live to be 105 and they have to pay you an income stream for 105, you beat the house. But the insurance company, they don't care because they know out of that 1 million people, most of their customers are not going to live to be that age.
Yeah, and I didn't tell you I was going to pop that question. You answered it perfectly. Something that you and I have been talking about is we know our clients intimately as far as their health details go. And so we kind of feel like a lot of our clients are healthier than average. They tend to be planners. They tend to kind of think ahead. And of course, if you're thinking ahead financially, you're probably thinking ahead health-wise in a lot of cases. And so we have this thesis that a lot of our clients could beat the house just because they skew to be healthier than average.
That's true because the insurance companies, they're no dummy. So if you have like a long-term care insurance policy, you have gone through pretty strict underwriting. So the insurance companies have already checked your health out and they have determined that you're probably not going to be needing long-term care anytime soon. So you're probably going to be in the type of category who lives into their 80s or 90s. And if that's the case, just a good way to use a portion of your assets and to attach some guarantees to them. And it's almost like one other thought I was thinking about this, Drew, is it's kind of how when interest rates are low, people refinance their 5% mortgage
Yeah.
to get a 3% mortgage,
Yeah.
like
Everybody
a
did
few
that a
years
few years
ago.
back, right?
This is the same principle. So, I mean, you're refinancing, if you have an existing annuity or you have a CD, you're refinancing your annuity and kind of getting at the high watermark. Because my prediction, I doubt interest rates are going to be going higher. I think this is probably the high watermark, and it will probably be heading lower. So you kind of lock in at this high level and just bank on that return for at least 10 years. There's some products that will extend it to 20 years. It's simple interest return.
Yeah, so that is a great way to think about this is it's kind of the opposite of a mortgage. So we're at like, recent historical highs for mortgage rates, and that's a bad thing for home buyers, but it's a good thing for people who have some money saved. And so, we're just kind of trying to share this concept, but really nothing beats just a quick personal analysis. So let's cut to the chase. If someone's curious what their what their options and possibilities are, what should they do next?
Just reach out to us. We'll put the link in the description below. But we've been doing this for a quarter century plus. We work for you, not one company. So we have the ability to shop the entire market of these annuity companies and just show you all the rates and see which company has the highest rates and gives you the most benefit for the dollar put in. So call us, fill in, the form on our site. But if you do call us, there's very common you'll get myself or Drew or one of our assistants will actually pick up the phone.
So yeah, that kind of wraps it up. I think people that are kind of curious just take the proactive step, like they've already done in a lot of cases, to reach out to us, get that quote, see what it looks like, or just talk big strategy. We don't have like a one size fits all option that we shoehorn everybody into. You and I have talked about the different tools that we offer our clients, and it's all over the board. It's from long term care to MIGA annuities to fixed index. We can talk any of them.
Yeah. So if you'd like to get more information, fill in the form below, call us. We'd be happy to chat with you.
All right, cool, Derek. Let's wrap it up for today.
All right. See you guys. Thank you.
Bye bye.